Okay, welcome back. So after two monotonous videos lately, I'm so sorry about that. However, today we will talk about the accounting equation. That is a big step into the accounting how. So let's make accounting easy again, okay? First off, there is a fun fact about accounting. That is the accounting equation. It's the most popular and famous feature of the accounting area. Every single person has been studying accounting. They would recall and describe the accounting equation firstly if they were questioned about how does accounting works. So without further ado, we will find out what is the accounting equation. In the nutshell, the accounting equation is assets equal liability plus owner's equity. It means everything a business owns must be equal to everything a business owes. Or you can break it down in the theoretical style, that is, the accounting equations hands over the underlying framework for recording and summarizing economic events of the business, and regardless about size, forms, and nature of the business. So now, you guys may ask why the assets equal liability plus owner's equity. However, I will clarify that question right off by the end of this video, so stay tuned. Next, I would like to refer to an example in the slide. The IHA company totally owns 100 in assets while the company owes 40 in debt and 60 in owner's investment. So now, I want you guys to apply the accounting equation to this example. Firstly, on the left side of this equation, we got 100 in the company's assets following our example, right? Secondly, on the right side of this equation, we got the company's debts as well as the company liabilities equal 40. Moreover, the owners invested 60 for the IHA company. That indicated us the owner's equity equals 60. So to sum it up, we got 100 assets equal 40 liability plus 60 owner's equity. It is naturally balanced, right? I believe there are a lot of questions going around you guys has, such as why the liability equal 40 and why the owner's equity equal 60. I promise that it will be answered right away in the next slide. Okay, so next we will discover more about assets in the accounting equation. As we have been talking so far, in the nutshell, assets are everything a business owns which could carry out future services or benefits. For instance, if you are an owner of a pizza restaurant, your restaurant will own the delivery motorbikes for delivering pizzas to customers, tables and chairs to serve people who wants to eat at your restaurant, cash for trading, and oven for roasting pizzas. So mostly, all of those assets will carry out future services or benefits for the restaurant, and that is all. Next, the liability of the accounting equation. So the liability have a claim against on assets, which are debts and obligation of a company owes that the company must be liable to pay back. However, people are gonna question, what do you mean the liability have a claim on assets? So I will answer this query by referring to the example in the slide. IHA restaurant owes 1,000 from the ABC Bank, 100 on credit from supplier for buying materials, and 5,000 payable wage for employees. So basically, the IHA restaurant had been owed 6,100 in liability category. That is based on the concept above. If the owners of the IHA restaurant wants to stop doing business, the restaurant has to pay up the liability before the owner will collect the rest. So this is the explanation for the sentence. The liability have a claim against on assets. Next, that is the owner's equity. So the owner's equity is the ownership that is claimed on the entire company's assets after paying up liabilities. Moreover, it is often pointed out as the residual equity. We can see on the slide that owner's equity or residual equity equal assets minus liabilities, which means the assets of a business are claimed by neither creditor or owners. So to find out what's belong to the owner, we subtract the liability from assets. The remainder is the owner's equity, since the claims of credits must be paid before ownership claims. The owner's equity is often referred to as residual equity. So nothing fancy in here, okay? Okay, because the whole thing about the owner's equity which are too smooth and transparent. Therefore, I'm gonna crack it up a notch by introducing to you guys the 4 basic subcategories of the owner's equity. Those are the owner's capital, the owner's drawing, revenues, and expense. So let's dig in. First, we're gonna jump into the owner's capital category, or we can call it under a friendly name, which is the owner's investment. So the owner's capital category store the money that the company's owners has been investing in the business. Therefore, the owner's capital tend to increase the owner's equity. That was easy, so I think you can read the example for yourself, okay? Secondly, the owner's drawings. Okay, according I was mentioning in the previous slide that the owner's capital category is used for recording the owner's investment, right? So be realistic, when you invest your money into a company, it will consider withdrawing that investment later or earlier in the future, which totally depends on the financials, company's operation, health, right? So, the owner's drawing category has been born to record historical owner's drawings investment for their personal uses. Therefore, the owner's drawing tend to decrease the owner's equity. Oh, by the way, I think you can also read the example for yourself, okay? That is easy. The third is the revenues category. I think the word revenues is already defined for itself. Of course, the revenue category gonna record the money generated from the sales of goods or the performance of services in normal business operation. For example, you are the owners of the IHA restaurant. The money has been generated from selling food and drink to customer that will be recorded in the revenues category. Therefore, revenues tend to increase the owner's equity. That is pretty straightforward, isn't it? The final is the expense category. The expense category stores the money spent or costs incurred in the process of generating income for the company. For instance, the IHA restaurant's quarterly revenues are 1,000. However, the time was doing business. The restaurant has been paying 100 for local advertisements. So on and on, the IHA restaurant owner's equity, or you can call it under the name residual equity, is 900. Why? Because 1000 minus 100 equal 900. Therefore, the expense tend to decrease the owner's equity. Finally, we are done with the theory part, so I have been preparing some reviewing questions and we're gonna put it together. First, the accounting equation is assets equal liability minus owner's equity, which is true or false. Let's see the answer. The answer is false, right? It's quite obvious because following what we have been discussing, that is everything the business owns equal everything the business owes. Therefore, it has to be assets equal liabilities plus owner's equity. The second is paying wage to the company's employees. That is recorded into the owner's drawing category, which is true or false. Let's see the answer. The answer is false, right? Because the paying wage for employee has to be recorded in the expense category, okay? The third is the income of the company that will be recorded into the revenues category, which is true or false. Let's see the answer. The answer is true, right? Because the revenues category stores the money generated from sales of goods or the performances of services in normal business operation. The final is an owner withdraws his investment in a company that is recorded into the expense category, which is true or false. Let's see the answer. The answer is false, right? Because the owner who withdraws his investment, that has to be recorded into the owner's drawings category. Okay, so I'm gonna wrap up everything that we have been following so far. First, the accounting equation assets equal liability plus owner equity, it means everything the company owns equal everything the company owes. The definition of assets, liabilities, owner's equity, and the most important are the four subcategories of owner's equity. There are owner's capital, owner's drawing, revenues, and expense. So, coming back to our question at the beginning of this video, why is the accounting equation must be balanced? So, this is a question that took me a lot of slides to find out as well as summarize the answer. So, the accounting equation just basically records the reality that the new business starts from nothing to everything that the business come to possess after its creation. It was provided by the others. Therefore, it has to pay up to them. Okay? That is my answer. So, that is all for this video, and the next video will be about how to analyze business transaction. So, thumbs if you like it and sub if you love it, and see you in the next video. Peace.